2 years ago, in 2022, almost everyone anticipated a recession. The term recession was searched extensively on the internet. Fast forward to today, and we didn't have any recession, and the interest over the term plummeted. Shockingly, after 2022, all markets picked up, and we are having an everything boom recently. Bitcoin, S&P 500, and gold broke their all-time highs, and even the Nikkei 225 had a new all-time high for the first time in 34 years. In retrospect, it turned out that 2022 was the year that most markets bottomed. After all this, a few questions arise. Was everyone wrong in anticipating a recession in 2022? Why did people change their minds and become so optimistic? And finally, was the recession avoided or merely delayed? To answer those questions, we are going to rely on one of the most accurate indicators that predict recessions, the Sahm Rule recession indicator. This chart shows the Sahm Rule indicator and the US recessions from 1949 to the present day. And the blue horizontal line, which sits at 0.5 percentage points, is a threshold for this indicator. The accuracy of this indicator is astounding. In fact, it has 100% accuracy for the past 75 years and 11 US recessions. Whenever the Sahm Rule indicator surpasses the 0.5% threshold level, then it indicates that a recession is coming. Lo and behold, this indicator didn't give false triggers or didn't fail to trigger before any US recession. Stats are fascinating, but what is this indicator and how does it work? This indicator was created by a macroeconomist, Claudia Sahm, who used to work at the Federal Reserve and the White House Council of Economic Advisors. And this is how it works. When the 3-month moving average of the US unemployment rate is more than half a percentage point above the lowest 3-month moving average rate over the previous year, then a recession is signaled. It may sound a little bit complicated, but it is a very simple indicator, and we will see that in a second. Let's build the Sahm Rule indicator together so that it will be much easier to understand its logic and definition. We need to start with the US unemployment rate. Let's close up to today's environment for better insights. The black line represents the US unemployment rate, and its 3-month simple moving average is depicted by the red line. We need the unemployment rate to get the 3-month moving average of it. However, for the purposes of the Sahm Rule indicator, we will only work with the 3-month moving average of the unemployment rate. After dropping the unemployment rate chart, let's remind ourselves of the definition of the indicator. In simple terms, the Sahm Rule recession indicator is the difference between the current 3-month moving average and the lowest 3-month moving average rate over the previous year. In other words, we take the minimum point of the 3-month moving average chart and subtract it from its current value. In this case, the current value is the value of May 2024. Now we need to look for the minimum value of this chart for the last 12 months, from May 2023 to May 2024. Obviously, the lowest point is the May 2023 value. Now, when we identified the two components that we need for calculating the Sahm Rule, let's get the exact numbers and plug in the formula. As a result, we get the Sahm Rule indicator's current value, which is 0.37%. As we have already constructed and computed the indicator's current value, let's draw our attention to the big picture. As mentioned earlier, the blue line is the threshold level of 0.5%, and by definition, when the Sahm Rule indicator passes that level, a recession is predicted. Starting from late 2021, the level of this indicator increased dramatically, rising from negative 0.4% to today's 0.37%. Historically, there were recessions during which the US stock market experienced only shallow drawdowns and didn't go through 50% corrections. In other words, even though the Sahm Rule signaled all the recessions of the past 7 decades perfectly, not all of those were deep recessions. Thus, it would be prudent to shed light on the relationship between this indicator and the severity of recessions. To put things into context, we need to incorporate the chart of the S&P 500. At first glance, it can be noticed that when the Sahm Rule rises, the S&P 500 contracts. And that's very intuitive when you recall the fact that the Sahm Rule is based on the moving average of the unemployment rate. After all, a surge in unemployment rate is usually associated with recessions. From a closer look, however, we can see that it's not always the case. There were instances when if you sold S&P 500 stock when the Sahm Rule was triggered, then you would not avert any further drawdown. In fact, you would sell it at the bottom of the market. For example, during the recessions of 1953, 1957, 1960, 1990, and the COVID recession in 2020, the S&P 500 index bottomed when the Sahm Rule was triggered. It was the time to buy and not to sell. But during other business cycles, it would be the right decision to sell when the Sahm Rule indicator was triggered. The recessions of 1970, 1974, 1980, 1981, the dot-com bubble in 2001, and the great financial crisis in 2008 were the instances where you would avoid substantial losses if you sold your portfolio when the indicator was triggered. In the case of the great financial crisis in 2008, if you followed this indicator, you would have sold it near the top and avoided a 45% contraction of your portfolio. If you want to include this indicator in your toolbox of economic outlooks so that you can time the market, unfortunately, it doesn't give you a clear signal on when to buy or when to sell. This is because the S&P 500 bottomed when the Sahm Rule was triggered in 5 of the 11 recessions studied, meaning that it was a signal to buy. On the other hand, the remaining 6 instances of the Sahm Rule signaling a recession proved to be wrong time to buy stocks. Conversely, those were good times to sell and be short on the market. If other economic indicators are analyzed in conjunction with the Sahm Rule indicator, the picture may become clearer. Thus, it would be advisable to use this indicator with supplementary leading indicators if you want to improve your chances of correctly timing the market when the next recession arrives. Another drawback of the Sahm Rule indicator is that it's not always a leading indicator of recessions, as it is widely marketed. In fact, in all the 11 US recessions of the last 75 years, official recessions were declared by the National Bureau of Economic Research, or NBER, sooner than the Sahm Rule passed the 0.5% threshold level. It stands to reason that in addition to incorporating supplementary indicators, you can also look at this indicator without the threshold level, meaning that when it rises, it is indicating a higher chance for recession and vice versa. In other words, instead of waiting for it to pass the threshold level, you can draw your conclusions before that level is reached. By this strategy, you would increase the chances of timing a top of the market and selling before the recession starts. However, you also increase the risk of being wrong. After all, there were instances when the Sahm Rule increased in a steady way, however, it never reached the level of threshold. And if you have sold your portfolio by looking at the increase, not only you wouldn't avert a correction, but you would also miss on a substantial rally. Coming back to today's environment, it should be noted that the level of the Sahm Rule is elevated and has been in a steady uptrend for more than 2 years. We are going to pay close attention to this indicator in the upcoming months as it nears the threshold level. After all, this is an indicator that has 100% accuracy in predicting recessions, and that should not be overlooked. Another speculative insight of today's environment is that in case the US economy slips into a recession, chances are high that the trigger of the Sahm Rule indicator will not mark the bottom of the stock market as we are at all-time highs. Thus, it will be a good point to sell or take profits. In summary then, the Sahm Rule is a simple and accurate indicator designed to predict recessions. It is currently at elevated levels and sits at 0.37%, only 0.13% short of triggering. As with most economic indicators, it is wise to use the Sahm Rule in conjunction with other indicators. Most people who expect a recession in 2022 are now more positive, and only a small portion of them remained unchanged to their expectations. On the other hand, many economic indicators start to show cracks in the US economy, and the Sahm Rule is one of those. Either these indicators paint a wrong picture or the sentiment is over-optimistic. If history is any indication, then the latter is the more likely outcome. If you like this type of content, please let me know. Thank you for watching, and I'll see you next time.